Let's cut through the noise and talk about what actually happened this week. Gold crossed above $2,900 per ounce on Tuesday, before pulling back to $2,870 by Friday's close. That's a $700 move in less than 3 weeks. But here's what nobody is discussing. The last time gold made this kind of parabolic move in this short time frame was March 1980, 45 years ago. And if history rhymes, the next 90 days are going to be absolutely brutal for anyone who doesn't understand what comes next. I've been watching gold markets for over a decade. I've seen rallies. I've seen crashes. I've seen manipulation. But what we're witnessing right now is different. This isn't retail FOMO. This isn't crypto bros rotating into hard assets. This is central banks panic buying at a pace we haven't seen in modern history. The World Gold Council just released Q4 data. Central banks added 463 tons of gold in the fourth quarter alone. That's the second highest quarterly purchase on record. For the full year, central banks bought 1,037 tons. That's 3 consecutive years above 1,000 tons. Before 2022, the previous record was 656 tons back in 2018. We're not talking about a trend. We're talking about a structural shift in how sovereign nations view the dollar system. But here's the part that should terrify anyone holding long-duration bonds or cash. China just reported their official gold reserves increased by 12 tons in January. 12 tons. That sounds modest until you understand what's actually happening. China stopped reporting gold purchases for 18 months between April 2019 and November 2020. During that blackout period, independent analysts estimate they accumulated anywhere from 500 to 800 tons that never showed up in official reports. They're doing it again. Since December, China's official reporting has slowed to a trickle, but Swiss export data tells a completely different story. Switzerland exported 93 tons of gold to China in December, 93 tons in 1 month. Where did it go? It's not showing up in official reserves. It's not showing up in ETF holdings. It's vanishing into private vaults, sovereign wealth funds, and state-backed entities that don't report to the IMF. Now let's talk about what happened in the futures market this week, because this is where it gets really interesting. The COMEX April gold contract saw open interest drop by 18,000 contracts in 72 hours. 18,000 contracts is 1.8 million ounces. At current prices, that's over $5 billion in notional value that just evaporated from the board. But here's the kicker. While open interest was collapsing, trading volume spiked to 230% of average daily volume. That's not organic profit-taking. That's forced liquidation. Someone got caught on the wrong side of this move and had to cover fast. Let me show you why this matters. COMEX registered gold inventories, that's the gold that's actually available for delivery, dropped below 9 million ounces last week. That's the lowest level since August 2020. We're sitting at 8.7 million ounces right now. Meanwhile, total open interest across all contract months is 12 million ounces. Do the math. If just 73% of contract holders demand delivery, the entire registered inventory is gone. But it gets worse. Eligible gold, the stuff sitting in COMEX vaults that could theoretically be converted to registered if the owner decides to make it available, that's also dropping. We've lost 400,000 ounces of eligible gold in the last 30 days. It's leaving the system. Where's it going? Same place China's gold is going, into private hands that have zero interest in playing the paper game. This is the setup everyone has been waiting for, but nobody wants to admit is actually happening. The physical market is tightening while the paper market is desperately trying to maintain the illusion of liquidity. But the cracks are showing. Dealers are reporting delivery delays of 4 to 6 weeks on standard gold bars. 6 weeks. This isn't a supply chain issue. Refineries are running. Mints are operating. The problem is availability. The gold that would normally flow into dealer inventories during a price spike isn't showing up because owners aren't selling. Premiums on American Gold Eagles are running 7 to 9% over spot. That's double the normal premium. Canadian Maple Leafs are 6 to 8%. Even generic rounds are 3 to 4% over spot when they should be 1 to 2%. The physical market is screaming shortage while the paper market pretends everything is fine. Let's connect this to the macro picture, because that's where the real story lives. The Federal Reserve just held rates steady at 4.25 to 4.5%. No surprise there. But here's what Chair Powell said in the press conference that everyone missed. He was asked about the Fed's balance sheet reduction program, quantitative tightening. His response was carefully worded, but the message was clear. They're watching financial conditions closely, and they're prepared to adjust the pace of QT if necessary. Translation, if something breaks, they're ready to pause the runoff or even restart QE. The market heard steady rates and rallied. But the smart money heard we're getting ready to pivot again, and that's why gold didn't sell off. Now layer in what's happening with the dollar. The DXY dollar index peaked at 109 in January. As of Friday, it's sitting at 104.6. That's a 4.1% drop in 5 weeks. Meanwhile, the euro gained 3.8% against the dollar. The yen gained 6.2%. Even the British pound, which has been a disaster for 2 years, gained 2.9%. The dollar is weakening, and it's not because the U.S. economy is collapsing. GDP growth for Q4 just came in at 2.3% annualized. Jobs numbers are still solid. Inflation is cooling but not cratering. The dollar is weakening because global confidence in U.S. fiscal policy is eroding. The Congressional Budget Office just released updated projections. Federal deficits will average $2.2 trillion per year over the next decade. $2.2 trillion. Not during a recession, not during a war. During what's supposed to be normal economic conditions. The debt to GDP ratio will hit 143% by 2034. We're currently at 125%. Japan is the only major economy above us at 260%. But Japan owns most of its own debt. We don't. 50% of U.S. debt is held by foreign creditors, pension funds, and institutions that have options. Here's the uncomfortable truth that nobody in Washington wants to say out loud. We are past the point of growing our way out of this debt. Even with 3% GDP growth, which we're not sustaining, the math doesn't work. Interest expense is now the third largest line item in the federal budget, behind Social Security and Medicare. Within 18 months, it'll be number 2. Within 3 years, it'll be number 1. We're spending more on interest than we spend on defense, education, infrastructure, and veterans combined. And rates are still historically low compared to the 80s and 90s. If the 10-year Treasury yield goes back to 6%, which is below the long-term average, annual interest expense hits $2 trillion. The entire federal budget is $6.4 trillion. We'd be spending nearly a third of all government revenue just to service debt. This is why central banks are buying gold. It's not inflation hedging. It's systemic risk hedging. They see the same projections we do, and they're quietly rotating out of dollars and into hard assets that can't be printed, debased, or defaulted on. And it's not just central banks. Billionaires are moving too. Ray Dalio's Bridgewater increased gold holdings by 14% in Q4. Stanley Druckenmiller, one of the greatest macro traders alive, publicly stated he's long gold and short long-duration bonds. Paul Tudor Jones said in January that he's holding gold as a hedge against fiscal insanity. These aren't gold bugs. These are money managers who built their careers on reading macro trends before the market catches up. When they move in unison, you pay attention. Now let's talk about the 90-day risk window because this is critical. March and April are historically volatile months for gold, not because of seasonal factors, but because of quarterly rebalancing, tax deadlines, and fiscal year-end flows. Institutions that got caught leaning the wrong way in Q1 have to square up by March 31st. If gold stays above 2,800, there's going to be a wave of short covering that could push us through 3,000. But if macro conditions deteriorate, if we get a liquidity event, if margin calls start cascading through commodity markets, gold could pull back hard. I'm talking 15 to 20% correction in a matter of days, just like we saw in silver last week when it dropped 40% intraday. That kind of move shakes out weak hands, blows up leverage traders, and resets sentiment. But it doesn't change the underlying fundamentals. Here's what I'm watching over the next 90 days. Number 1, COMEX delivery intentions for the April contract. If we see standing deliveries above 7 million ounces, that's 70% of registered inventory. That forces the exchange to either find more gold fast or we get a delivery default, which would be catastrophic for price discovery. Number 2, Swiss export data. If exports to China stay above 70 tons per month, that confirms the accumulation thesis and tells us official reporting is still suppressing real demand. Number 3, Fed rhetoric around QT. If Powell even hints at slowing the balance sheet runoff before June, that's the signal they're preparing to ease again and gold will rip higher. Number 4, the 10-year Treasury yield. If we break above 4.5% and hold, that puts pressure on equities and could trigger risk-off liquidation, including gold. But if we break below 4%, that signals the market is pricing in rate cuts and economic weakness, which is also bullish for gold longer term. The unresolved tension here is simple. Gold is pricing in a future where fiscal dominance wins, where central banks lose control, where inflation comes back because debt can't be serviced without currency debasement. But the market is still pretending we can have soft landings and controlled tightening and fiscal responsibility. One of these views is right, the other is catastrophically wrong. If gold is right, we're in the early innings of a multi-year bull market that could take us to $4,000 per ounce or higher. If the market is right, gold is about to correct 20%, and everyone buying up here is going to regret it. I'm not going to tell you which side to bet on. That's your decision. But I will tell you this. The physical market doesn't lie. When premiums are 8% over spot, when delivery times are 6 weeks, when central banks are buying at record pace, and when inventories are at 4-year lows, that's not speculation. That's supply and demand telling you something the price hasn't fully reflected yet. The smart move right now isn't to chase price, it's to understand risk. If you're holding physical gold, bought below 2,500, you're sitting on a nice gain, and you have cushion if we pull back. If you're thinking about buying at 2,900, you need to accept that the next 10% could go either way, and you better have conviction. In the long-term thesis, because short-term, this could get ugly. If you're trading futures or leveraged ETFs, you're playing with fire. The volatility we just saw in silver is coming to gold. When it does, margin calls will be brutal and forced liquidation will create opportunities for those with dry powder and strong hands. One more thing before I wrap this up. I've seen a lot of comments asking about mining stocks. Should you own them? Are they better leverage than physical? Here's my take. Miners are not gold. They're businesses. They have operational risk, political risk, management risk, and debt risk. When gold went from $250 to $850 in the 70s, homestake mining went up 1,500%, but dozens of other miners went bankrupt. If you're going to own miners, own the best operators with low-cost production, strong balance sheets, and jurisdictions that won't nationalize them overnight. And even then, understand that miners can underperform metal in a manipulated market because shorts target equities harder than they target physical. Personally, I hold both. Physical for wealth preservation, miners for leverage. But the core position is always physical. If you don't hold it, you don't own it. So where does this leave us? Gold just broke out to new all-time highs in a move that mirrors 1980. Central banks are buying at record pace. China is accumulating off the books. COMEX inventories are at 4-year lows. Physical premiums are spiking. Delivery times are stretching. The dollar is weakening despite solid economic data. Deficits are exploding. Interest expenses crushing the budget. And the Fed is preparing to pivot again because they have no other choice. The next 90 days will determine if this breakout holds or if we get a brutal shakeout that traps late buyers. Either way, the long-term trend hasn't changed. Gold is going higher because the debt can't be paid, the dollar can't hold value, and central banks know it. The only question is whether you're positioned for the volatility that's coming or whether you're going to panic at the worst possible time. Do your own research. Understand the risks. Don't trade on emotion. And remember, the market can stay irrational longer than you can stay solvent, but in the end, math always wins. And the math says gold wins.